Now let us look at the other aspects of the IFRS 15: transition, presentation, and disclosure, and other impacts and challenges. So the standard is applicable from first of any period finishing after 1st of January to 2018. So the standard has already been applicable. If the company is adopting the IFRS now for the first time, then there are two methods at which you can apply the IFRS: full retrospection or the modified retrospection. So full retrospection means you are going to assume that each prior period is going to be a separate period, and you are going to redo the entire IFRS 15 separately. But you don't need to restate the completed contracts already, which are within the same annual period. If they are finished within the same annual period, then there is no need to restate them. But if they are not finishing within the same year, then you have to restate them. And you don't need to estimate the variable consideration in the comparative periods. And also there are certain relief from the disclosure. But if you follow the modified retrospective adoption, which means we retrospectively we with the accumulative effect on the date of initial application, means that you will be preparing a comparative in the previous in the under the prior IFRS, and it will be applied only on the existing contracts and the new contracts, not on the completed contracts, even if they fall within the 2 years. And but the only thing you need to do is to adjust the opening retained earnings. So that is the transition. Now, what is the presentation and disclosure requirement? So the presentation and disclosure requirements, normally you have to represent the contract as a contract asset and contract liability. So certain obligations you might have to represent as a contract asset, depending on the relationship between the company's performance and the customer payment. If you receive the advance, it will be your contractual liability, because you have not earned it yet. If it is and if the company has done anything and it is not entitled to bill, then it will be contract asset. If they are entitled to bill, then it will become a receivable. So you need to specifically separate out what should be the revenue and what should be the liabilities, and how what are the contract asset and contract liability. So here you can see on the screen an example which is given in the IFRS itself, that the company enter into a contract to deliver the product to a customer on 31st March. The contract is non-cancelable, and then means you require an advance payment of 5,000 on January 31st, and there is not had to pay anything until the 1st March. So on 31st of January, you will receive, because this non-cancelable, you can always receive, always credit as a receivable, and credit the contract liability first, because you are not entitled to recognize the revenue yet. On March 1st, when another cash is received, then you will receive the receivable. On 31st March, you will satisfy the contract liability and recognize the revenue on 31st March. So this is how the revenue is going to be recognized. So on a monthly balance sheet, you will show contract liability or receivable or the revenue. So the disclosure has to be, we are also showing the disaggregation of revenue, which might be the additional only disclosure requirement in addition to the IAS 34 to the interim standards. So basically you need to disclose the disaggregation of the revenue, information about the contract balances, remaining performance obligations, and the information about the performance obligations. So you have to generally broadly describe it, because all the contracts are separate. So if the company has thousands of contracts, then it will be very difficult for them to disclose each and every contract performance obligation related with each and every single contract. So you might have to group them into similar contracts and then present the total value. You also have to disclose about the significant judgment and estimates in relationship with the transaction prices, the allocation methods, and the assumptions. And other disclosures you might have to do is the policy decisions, what kind of rate you are using the time value of money, and what are the contract assets in relation with the things. So the disclosure requirement example is here. This is how you need to follow the contract the disclosure requirements. So here in this example, the entity enters into two contract A and B with the separate customers to provide services, and it is both 2-year contract and non-cancelable. One is $100 a month, and then $100 a month plus a performance bonus ranging from 0 to 100,000. And they estimate that they will be entitled to a $600 variable consideration. Progress is obviously time based, and frequencies as and when needed. So in the first contract A, the entity has to disclose the amount of transaction price that has not been recognized yet as a revenue, as a table. Quantitative time illustrates. So here you can say 2009 and 2010. Um, you are recognizing 1200 and 1200 is the total, and 6 months into 2020 total is 1800, right? So that is the revenue. While the contract B, you have to also transaction price is 3100 into 24 plus the 600 variable. So you may have to also look at that recognized evenly over a period of 24 months. That is 1500 per year. And then 1005 divided by 2, 750. So for 6 months, 1750. So this is how you need to recognize, disclose the how much is the what is the transaction price, what is the allocation, how we are allocating the performance bonus, how we quantifically how we are estimating that we are going to get the performance bonus. So these are all the disclosure requirements in the performance obligation. These are some additional disaggregation of revenue. So basically the revenue disaggregation, as you know, the and in the segmentation segment, IFRS related to segments, you have to segment by geography, by the significant market, and also by the product or services that we are selling. So here is the importance of the allocation of the transaction price that we have seen in the past. If the transaction price allocation is not correct, then this segmentation, the disaggregation of revenue will not be correct as well. So we have to be very careful in this. It's also, you can disaggregation of revenue can also be the type of contract, means the fixed price contract or the time and material contract. It can be short term, long term. It can be the timing of the revenue recognition at a point over a period of time, and the sales channels. So these are the additional disaggregation of revenue that we have to provide in the IFRS. So the companies might have to see how they are going to provide this market segmentation. The accounting standards, the accounting records, and the revenue records has to be probably modified in the way to capture this information on an ongoing basis. So this can be quite challenging to provide this kind of this kind of disclosure. So the impact, challenges and issues related to the IFRS 15 we are going to discuss in the next video.